Good afternoon. My name is Roy Weiler. I'm the Director of Trading Operations for Time Leverage Capital. For anyone who's missed our previous webinars, please give us a call at 800-519-9085, and we can send the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as Chief Strategist of Dow Jones Megatrends, an all-markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Hot Market Fridays, the Panic Volatility Index, an answer to large-scale crisis. Mr. Mueller? Mr. Mueller?
Thank you, Roy, and TGIF to everybody. Today we're going to have a discussion within the context of options and volatility of what could be one of the most interesting instruments and useful instruments to emerge for people who follow volatility and are concerned about major events in the market. Today we're going to be looking into the volatility futures contract and doing an initial discussion of how these kinds of positions can be used in combination with option strategies. First of all, let's just have a big look at the 100-year history of volatility, looking at the Dow Jones Industrial Average. This is based on a 21-day measure. And as you can see here, there have been, going back, periods of significant spikes, most notably during the crash of 1929. As you can see, there was an enormous spike in volatility. And oddly enough, for the much more short-lived event and less severe event in terms of long-term consequences, we have the crash of 1987, which had a very similar spike in volatility, and of course then we will go into a more detailed view. What we see here in general, and has been borne out mostly in particular, is that although the volatility index measures equally whether prices are going up extremely or down extremely, it appears that to the extent that it is called the fear index, the panic index, some people have even called it the plague index, the drops create a greater rise in the volatility than the rallies. So although this measures volatility, it has been found, and I think has to be viewed from the standpoint of risk aversion, and that people are sometimes motivated by fear more than they are motivated by a comfortable status quo. The volatility index, as the fear index, is basically a way of measuring whether consumers are complacent or not too complacent. So in a way, it's a viewing consumer sentiment, and also a way of viewing the level of complacency that people think things will proceed quietly during periods of low volatility, or anticipation of major changes and fear of events in either direction, of major events in either direction, will increase volatility, and again, some more to the downside on average, and we will see some, this is a longer term view again, where we see significant spikes in volatility, sometimes after sustained periods of low volatility, and especially again the correlation between spikes in volatility and rising and dropping markets, which I think is fairly obvious in terms of the more pronounced moves. On the other hand, as you can see, sometimes during explosive up moves in the market, volatility can also spike. So if the market is too complacent in any direction, if people are too flat about the market going down or going up explosively, and the volatility index is low, somebody anticipating an unforeseen event would be betting on rising volatility. So let's have a look here. And in this particular event, the chart is focusing on several and entirely unexpected crises that spiked the market fairly significantly, and some of them with memory and the benefit there was a great deal of fear in the market at this level, and although the market did not really end up dropping, just a level of fear and concern at this particular level caused a spike in volatility. So in this particular scenario, as you see, although the market held, in the longer term, volatility on fear spiked significantly. We have a similar event with the Russian debt crisis, as you will recall, and on we go with the prick of the internet bubble. Again, we see here that we had a very significant we had a significant amount of fear. In this case, a significant drop as well, and you see as the fear level really hit when the market broke or looked to be breaking through some support there, as it eventually did, and we had more spikes of volatility. Of course, 9/11 was a very big spike in volatility, took the index near 50. Likewise, on the internet bubble, and on we go. And of course, we have Lehman Brothers, which resulted in an extraordinary spike in volatility. And again, for people who were hedged to some extent using a volatility index or in other ways understood the significance of a low volatility environment here, a variety of solutions might have appeared, and likewise in these other crises. So one thing that we know is that one of the things that people say is the cure for low prices is low prices, the cure for high prices is high prices. I think the same can be said about the expectations of individuals. We have inertia. We become complacent when things are quiet, and we become panicked when things seem risky, and eventually we revert to the mean. So let's have a quick look now, and we'll look more closely at these crises and the VIX index itself right now. And the VIX contract is growing spectacularly in popularity. The SIBO recently just announced expanding hours. This contract will trade almost 24 hours a day. So the hours are extending, the margins are changing. It appears to me that the demand for this instrument will increase in good part because of the world of structured products and annuities, where at one time volatility and risk were measured by purchasing corresponding instruments, so these structured products could pay off. Now a volatility index, as we've just seen, is really beginning and growing by leaps and bounds as an instrument for those types of entities. So there may be some built-in support as people try to have structural defenses against greater market risk. And again, because of the utility of using a volatility index to hedge risk or to take some sort of direction or a more nuanced position, in addition to the VIX, which is the more well-known and popularly followed index, there are also indices in the gold market. And as you can see, we are looking at an index which is not entirely current, but there's a very significant amount of volatility in gold. And we can see that the volatility in this particular market can go up for a variety of reasons at various times, and in certain cases just low volatility itself may be a precursor to a move, as invariably the the gold enthusiasts come out, and of course you do have the bearish, scary pullbacks as well with spike volatility. So it seems to me that buying complacency and selling panic may be another way of finding direction in the market. And in addition to gold, there is a crude index. There's an index on grains. There's an index on the dollar, and a number of these indices. Before we go to the specifics of the futures contract, I want to point out the importance of looking at volatility. When you look at our strategy gallery, which is where we compile all our trades, of course we want to have a directional outlook, which goes without saying, and that's exclusively what most people do. But as a point of discipline and as a way of having a trade that is informed by a greater series of facts and information, we also have a volatility outlook to go with a directional outlook. Volatility is that important, and because volatility calculations are essential in every option transaction, as you can see, having an instrument, which is a direct volatility instrument to perhaps not exactly arbitrage, but to nuance positions with volatility and direction, is a wonderful and a perfect complement for from a standpoint of knowledge and for any option trader or speculator. And just to show you an example, when we just pull out a basic trade like selling a put, again, we immediately portray the graphics of the trade, but in addition to direction, we immediately show the effects of time erosion, which are factored into the VIX contract. In fact, they're factored by breaking down a year into minutes. So the time decay is significantly factored in, as well as the volatility outlook. So a person could nuance this volatility outlook in this position by using a VIX contract to work through the prices, and again, by having a broader VIX number, you can look at specific series of options and specific quotes and say, this is where I want to look. By the way, just since we looked at the selling a put position, please bear in mind that when you go to our strategy gallery and you find a particular trade such as this, you can go inside to see the kind of a general reminder of the details of the trade, and for those who need it, a short demo video of what the trade contemplates and how to input a trade using the Option Ranger software to pull a spreadsheet. Finally, in looking at the S&P 500 index, we've already compiled the specifics. We are going to be doing this on the VIX, which again is going to have expanded hours, and we've already shown you the tick values. The margins are changing. They just went above 4,000. And this is a list of primary and secondary sources of information that actually I compiled over the year with my colleagues on the Dow Jones writing staff when I was working with them to put out the Megatrends publication. And these were the factors that we came up with as a list to follow when trading the S&P, and we're always updating this list. Parenthetically, it's very interesting that we have items such as EU stability, energy, FOMC, and so on, and some of these items have been on there for years and still continue to be a factor. So our S&P, our VIX page will look like this. We'll have some different hours and some different resources listed. So now let's go ahead and go and do a calculation using the VIX contract, and this is a basic calculation, so we can just use our basic futures calculator. Just a moment, and let's see what we have there. Okay, I believe that we have been input here. So the contract market is the VIX. As you can see, the moment that the contract market is input, these contract specs appear with a tick value, and as you, we will be adding this link as we have on all the other contracts to the contract specs page. In this particular case, we're going to model out buying a future. So the time decay is not a factor. This is a tick for tick move, so you're not paying premium. So the move is tick for tick up and down. This bet would be a bet that the volatility in the market will increase. Let's go ahead and use one position. and we will input the price of and again, there's no premium. As you see, the premium box is blocked out, so we make sure that only the right boxes appear based on the trading strategy selection. So in this case, we'll put the futures price as, shall we say, 1550. I think we ran this example, yes. Oh, just a moment. I think we actually ran this example yesterday, just a moment. So let's go ahead and pull up the VIX example, buying one at 1550. Let's put in a default rate and calculate. Okay, again, there's no premium paid or collected. The trade is factored in, and immediately the futures break-even point, which is calculated here. And let's see what else we have here. Hold on a second, and we have a grid showing the drop. Now, as you look at these prices, you look at the volatility index. This is a margin trade, so you have to consider how much leverage you want to use. And when you can look at this grid of drops and losses, then you can look at the grid of rallies and gains, and then see where in this range you think, if this range makes sense to you, go ahead and you try to get yourself positioned. Again, the key item here is that you are aware of the margin risk on the drop and make sure that you can tolerate it. So let's have a look at a long-term VIX chart. Just a moment. Okay, pardon me. And as we look here, this is a weekly VIX chart. And I'll go to a shorter term chart. So as you can see, we had some periods of low volatility. Now there may be some attempt to break out. There's a volatility somewhat up, as you can see over here. And going back, and not even going back that far, we've still had our volatility at just a moment. Let me pull out the cursor. Okay, so as you can see here, we've had prices get this to almost 22 here not so long ago. We've had prices at 20, and you can almost look at these events and figure out what prices of the moment spike these. You see things back in October. You see things back in November and December. That's a lot of that budget stuff and government shutdown talk and that was taking place. And of course, we have this looks like Syria over here, and then usually followed by periods of complacency. If we look at a shorter term chart, as you'll see, the volatility has been dropping on a daily chart and is still relatively low. Although it has attempted to break out here, oddly enough today, early in the day while the market was holding, it being a Friday, the short term was still up. Hold on just a moment, which shows that people were still a little bit nervous and buying different options. So you see here that although the market stabilized, the VIX was continuing to go up and is continuing to move on fears ahead of the weekend and perhaps on a variety of economic factors coming out of Asia, concerns about the U.S. economy, geopolitical instability, and so I think that we're getting more towards the top of a recent range. I don't know if that's a breakout or if one should wait for a pullback to support if one happens to buy. But if you look at a very long-term chart, intuitively and based on common sense, it appears that once levels of volatility get pretty low, and let's go back to the weekly, which is so telling, there are just certain levels, and you don't see a lot of action dating back quite a while, that finds its way under 20 for any sustained period of time. We're still under 20. And of course, these dips here, you get to if you get to the 15 level, 14, 12.5 seems to be very powerful support. And of course, intermittently, you have these major spikes. We're going back here to 2009, and obviously we all know what happened there. We have a spike here to 62.82, based on the VIX contract, which we saw earlier. Based on the VIX contract that we saw earlier, if the market is at, let's say the market's at 17, and you go to 62, that's a huge move. The VIX can't really go negative. In other words, there will never be zero volatility in options, zero fear, or certainly zero speculation in options. So as long as there's speculation and time value in options and volatility premium, the volatility index will be worth something. The greater the fear, or the greater the enthusiasm, the higher it goes, with a bias towards the panic element of the market. So finally, let's go ahead so when you are modeling out these trades, we'll look at the VIX futures contract. We are looking at an instrument that can hedge risks, that is very efficient in its pricing. If you look at the volatility, and we're not going to get into that discussion today, but in terms of nuancing portfolio risk and nuancing option positions, whether paying premium or collecting premium, and identifying skews in volatility and pricing of particular series of options, as we examine these various strategies in conjunction with the corresponding volatility index, I think will offer traders a greater insight in how to trade their positions, how to understand their positions, and how to modulate risk using these volatility indices, again, which are so quickly growing in popularity, because as markets get to lofty levels, fear of loss is becoming greater, and concerns about overvalued stocks are prevalent among many people, including people who are still significantly exposed to equity prices and market risk. I think that in addition to the possible use of actual S&P options, and again, we can look at various strategies for hedging and using S&P puts, Dow puts and calls, and a variety of the S&P 500 mid-cap and other series of options for direct hedging. The VIX offers an advanced instrument, and an instrument that does not cost premium while being able to speculate on volatility. So are there any questions?
Yes. Are there VIX indexes on other markets?
Yes, it's a very good question, and by the way, I'm proud to say that we actually have had the domain VIXfuturestrading.com, and we are developing to list the major volatility indices. Let me just go ahead and review this very quickly. There are currently indices on the VIX itself, which is well known, on the S&P 500. There's an index on the gold market, which is well traded. There's an index on the crude oil market, which is well traded. We have indices also on the U.S. dollar index, a volatility index, and there is also a grain volatility index. So these volatility indices, if you're going to trade in a particular market, depending on your game plan and your suitability and what falls within your parameters of risk, reward, and financial objectives, I think it is important to understand how a volatility index on any given market in which one is transacting can be used to have a more sophisticated, a more nuanced understanding of the trade, and to more clearly try to plan a trading strategy having all of the information in mind that is available. The volatility indices are not only a trading instrument, they're an indicator for decision making. So if somebody doesn't want the index, but they are a buyer of premium in a particular market, and they want to make a decision looking at our trading outlook over here. So somebody says, okay, I'm thinking of buying calls in the S&P. And they have to look at this and they say, well, I'm going to buy calls, I have to be bullish, and I have to expect rising volatility. one of the ways a person could decide whether or not they want to buy that call, which anticipates rising volatility, is by having a look at the volatility index. So by looking at the volatility index, that's not a cup of coffee. That's a Java program. Okay, let me go ahead and close that up. My apologies, I hit the wrong button. Here we go. As you look at the volatility index, let's say somebody wants to say, let me see, do I think volatility is going up and I'm going to buy a call? For better or worse, however that person sees this chart, they'll have a sense of volatility. If they think, wow, look at this, volatility just broke out, it's going up, if that's their opinion, then they would buy a call. On the other hand, if say, well, you know what, this is really overdone, the volatility is high, the option's probably a little more expensive than I'd like to pay for it, let me look at buying that maybe when volatility comes somewhere around here, and then I'll look to buy a call because it's going to cost me less premium. So this is one of the ways in which that very important item on volatility outlook can be answered, not necessarily by trading the index itself, which is suitable and a great idea for some and not suitable and a bad idea for others, but it's also a way of making an informed decision on the volatility outlook that you have for the market so that you can select the appropriate strategy. So let's say the same person says, you know, let's say somebody else looks at this volatility, is creating a volatility outlook, and they look at this thing and they say, you know what, I think this thing is going down. Now, maybe a short-term speculator who thinks the market will hold can short the VIX because they think it's going to get back down here, and they can trade it back and forth. I mean, this is a very liquid instrument that's going to be trading 24 hours a day very soon. That's one possibility. Or that person can say, I think the volatility is going to go down. I'm going to sell a call. I think the market's going down. I think the volatility is going down. So let's say they come up with that kind of an outlook. So they say, okay, volatility is going down. The market's going down. They go back to our strategy gallery. Okay, and let's have a volatility falling, market bearish. Okay, let's go down the bearish column. And this person came up with a theory that the volatility is falling. So he's got a strategy. He either sells a call, you click on this, you go to the description, and soon all of these will have the training video. This one, I believe, is still the description at this moment without a trading video, but that'll change shortly. And the other possibility is to do a ratio put spread, anticipating a drop with falling volatility. Now that person can make a nuanced decision based on how far they think how much volatility will fall, or perhaps how much the market will fall, to decide on the particulars of these trades. But again, we have here an instrument. Now let's say somebody thinks volatility is falling, but maybe they don't think it's going to fall a lot. So that would be, again, a totally different trade in terms of what call they write, and they would have to have a very strong directional outlook in order to use that strategy. So as you can see here, we can definitely be more informed in terms of having a definition of our own on volatility by using these indices where they are available. And there are ways of combining the VIX. If you look at the numbers, if you look at the strategies, in which you can say, and again, I'm not recommending this idea, it's just an example. Let's say somebody has an idea that the market's going to hold and the volatility is going, that the market's going to hold and go up, and that volatility may not go up. You just kind of fiddle up or hold, and they can go ahead and sell a put. Now, let's say they sell a put and they think there's a remote chance. Let's go back to the gallery. Let's say they sell a put, which is a bullish trade. Just a moment. Which anticipates falling volatility. Let's say somebody sells that put, they collect a decent amount of premium, but they say, you know, I'm looking for volatility falling, but it's kind of low anyway. On the other hand, I really want to sell a put, but what if Putin does something crazy or something happens in the Middle East? The person who decides to initiate these types of strategies could turn around and say, let me go ahead and complement this position with a long VIX position, so that if my volatility outlook is incorrect, if I expect that the volatility is going to fall, and in fact it goes up and this short put gets in trouble, I'm going to be making money on my VIX. Or if they think the volatility is going to stay the same or things are going to be quiet, again, they can hold value on the VIX while this position erodes. On the other hand, if the market drops hard against the short put, presumably the volatility will go up. To look at both those factors in tandem in order to select a trade makes a lot of sense. From a long put risk management standpoint, of course, we have to go back to the basics, and I believe it is important for people to have that holdings or risk in particular areas to bear in mind that various events come up during which volatility goes up. As we know from the present time, a lot of these events eventually, there we go, will unfold, and fear will go up and down, as we can see over here. I think on that basic premise about human nature, it is interesting for people to accumulate volatility positions during periods of great complacency, because unfortunately nobody knows what tomorrow brings, and if it brings a panic event, again, we all hope that the panic event goes away, and in the best case scenario, some sort of panic event position can benefit, and hopefully after it benefits and mitigates some of the losses on a corresponding instrument, it will enable investors to have greater flexibility on whether to hold, whether to sell, and certainly if they're going to hold, it provides a way to hold with some sort of volatility plan. So are there any other questions?
No, not at this time.
Okay, well, thank you all for attending. Please keep following up on our VIX information, and if you have any questions for us or you want to model out any of the volatility trades, let us know. We are setting up a volatility tab, and we will be adding the other indices in the near future to the calculator, and also creating the specific sections for each volatility index in the market section. So thanks again for attending, and have a great weekend.